Hi, everyone. Thanks for being with us today. It is a really unique privilege to be hosting one of the world's greatest investors and having the opportunity to gain his insights on risk and trading. Our guest began his career in markets at Pittsburgh National Bank, of all places, and he began in equity research. In 1981, he left the bank and started Duquesne Capital based in Pittsburgh. And after a few years, he left and started his own firm called Duquesne Capital. A few years into running Duquesne, he was hired by Dreyfus, and he only went there on the condition that he could continue to run Duquesne. And then in 1988, he went to work for Soros, working with George Soros and running his quantum macro fund. While Stan was there, the fund grew to $20 billion in assets. And throughout his time, both at Soros and at Dreyfus, he continued to run Duquesne Management. Here's some facts on Duquesne. Duquesne has never had a losing year, and it was founded in 1981. His assets, while not disclosed, is something greater than $10 billion. His annual returns, while not disclosed, exceeds 25% per annum, which, by the way, in the same period, makes him a more successful investor than Warren Buffett. His total staff is less than 100 people, including the back office, and that's what he uses to generate those returns. And for us, he is probably the most professional and valued client we have because his firm operates the way he does, always in the most professional manner. He's also an important member of the New York community. He is a very active chair of the Harlem Children's Zone. He's on the boards of the Environmental Defense Fund, of Memorial Sloan Kettering, and of the Children's Scholarship Fund. For me, and I say this with complete sincerity, it has been an utter privilege to have the ability to talk to him most weeks for the last few years, and I hope you will find that's true today as well. Please join me in welcoming Stan Druckenmiller.
Can I get a peek at the questions?
Yeah. When I asked Stan if he would come do this, he said, "So wait, let me understand this. All I have to do is listen to your questions and be honest with the answers." And I said, "That's all you have to do." He said, "Fine, I'll do it." So let's start with you're a director of investments at a bank of tender age of 28. How did you learn to trade at a bank as the head of research?
Well, I started at the, I give you a little background. I started at the bank at 23. I dropped out of graduate school because I wanted to get a PhD in economics. It took me about a semester and a half to figure that wasn't going to work. And I got a job in construction. And then the only job I could get was at Pittsburgh National. And I started in the training program in a bank. You're a teller, you go through the credit department, and everybody wants to go to the credit department. And I thought I was pretty smart. There were 12 of us. I had a pretty high opinion of myself, and I went in after we went through the training program, and the guy at credit said, you couldn't sell snowmobiles in Alaska if there was no other transportation vehicle there, so we have no use for you anywhere in the bank. But there's a guy up on the 30th floor whose personality is worse than yours, who runs the trust department. You know, he's a great investor, but you should call him up and see if he'll hire you. So I called the guy up, and he said, "Where'd you go to school?" And I said, "I've been at University of Michigan." And before I got out, he said, "I went to Michigan, you're hired." So I went up there, and I started as an analyst in the banking industry and the chemical industry. And I've been doing that about a year and a half. I think I was 25. This guy was really quirky, okay? And he got in a fight with the top management of the bank. And no, that was later, I'm sorry. So there were about eight guys in research, and I'd been there about a year and a half, and he promoted me to be director of research, which is a little crazy because everybody else had an MBA, they had more experience. And I'd like to say it was something to do with me, but I think it was just this guy wanted to show them how powerful he was, that he could make them all report to this 25-year-old. So they all hated me, and it was sort of working out because this guy protected me, and then he got in a fight with the guy up above him. So he's gone to Eastern Airlines, and I'm there at, I guess, 26 now. And there's the charitable guy, there's the pension guy, and there's the individual guy, and then there's me, director of research, all vying for power. And this guy that ran the thing was a lawyer, and he didn't understand anything about investments, but he'd sit on the investment decisions. They hadn't made a decision about who was going to be director of investments. So the Shah of Iran had just been overthrown. I was 26, had more courage than brains, didn't know about diversification. I said, well, this is pretty easy. Let's put 70% of our money in oil stocks and let's put 30% in defense. These guys all said, well, that's nuts. You got to do diversification, blah, blah, blah. I said, no, that's what we should do, and you know. So the lawyer's listening to this, and he doesn't know anything, and so my stock selection list went up 300% in 2 years. The S&P was flat. Bonds went down the tubes, which I hated. Now, if you asked me that question any time in the next 10 years after I was more experienced, I probably wouldn't have given that answer. But that's how I became director of research. And this guy that mentored me, even though he was quirky, he was an investment genius. And he was very trading oriented and actually very chart oriented, which was good for me because when you get promoted at the age of 26, you never really learn fundamental analysis, and charts are kind of quicker and easier if you want to see what's going on. So actually, Jeff, I learned from this guy because he knew about things like if all the news is great and the stock's not acting well, get out, which is a pretty simple thing that for some reason most analysts don't know. He taught me more what makes stocks go up and down than analysis itself, which is, it's 90% of the function, but I'd say about 10% of the people is what they focus on.
So if we were just to jump over to the technical versus fundamentals, when you're making an investment decision or a trading decision, how do you piece the two together? How much time do you spend looking at charts today? Okay,
so every night at about 4:30, I get 272 charts. They cover just about every group in the stock market, every commodity, every currency cross I'm interested in, every fixed income market around the world. And they're basically daily, weekly, and monthly. Daily is supposed to predict 8 to 20 days, weekly 8 to 20 weeks, and monthly 8 to 20 months. When I make an investment decision, it's usually, sometimes, believe it or not, the idea comes from the charts, but I will never invest just on a chart. But if I really like a fundamental thesis and the chart stinks, I won't do it. There's, my old boss used to say, in terms of stocks, I apologize to women in the audience, there's 6,000 girls out there. If 20 or 30 of them look great, I don't need to bother with the rest. And you can always find, at least in terms of equities, 20 or 30 great fundamental stories that the chart looks good. But I always assume that the market may know something, and I've always had a great deal of respect for the market. So I'd say 75 to 80% of my ideas come from fundamental, and then they're verified by the chart. But I've also found ideas from the charts and then discovered the fundamentals. The charts we use, because I took a shortcut to my career, as you can hear, charts were a great tool for me early on because I didn't learn a lot of the fundamentals in time. But I was introduced to all the top chart systems throughout 20 years. And we ended up buying a system and bringing it internally. And because it used second derivative rate of change, these things will often bottom a year to a year and a half before the fundamentals. So they'll give you time to study the thesis. So that's why sometimes the charts actually generate the initial idea and then go and try and find a story.
Before we get back to your career, I just want to, on the charting thing, ask you about one trade. So you know I had lunch in March of last year. It must have been a week or two after Bear Stearns failed. And
Talking 08?
08. And you
That's a bad week for me, but go ahead.
no wonder you weren't eating much. And we were talking about commodities, and you said, look, I'm as bearish as can be on the economy. I don't get what's going on with commodities, but my charts are telling me they're going up. So I'm long. Every chart now, all the rest of us who were really bearish on the economy were short commodities. How did you reconcile the fact that you were really bearish on the economy, but you went long commodities because the charts told you to do that?
My recollection is I just saw so much liquidity that was going to be provided worldwide that I was willing to go with the charts. I do remember the reason we did fine in 08 was around May or June, those charts started to look quite dodgy, and we got out. But I believe at that time, it was pretty obvious to me that Bernanke and company and everybody were just going to put pedal to the metal after Bear Stearns, so I was willing to believe the charts in terms of commodities.
So back to, so at some point you made a decision to leave the bank and start your own fund.
Yeah.
What drove that?
How about running $6 billion with the best record I knew and getting paid 43 grand a year? I mean, these guys... You guys are complaining about what they're doing to you? Okay. So, most people reporting to me were making more money, which I thought was a little weird. My mentor had left, and what really happened is I came up to New York to a dinner, and I gave this presentation on gold. And there was a guy at the dinner, and he came up to me after and he said, "You don't sound like you're from a bank." I said, "Well, I guess that's a compliment, thank you. Apologies accepted." And he said, "Well, why aren't you out on your own?" I said, "Well, I'm 27 years old, and frankly, I don't have any money." He said, "Well, how about if I pay you $10,000 a month to talk to you? You don't have to write any reports, nothing. I'll just pay you $10,000 a month to talk to you." So I was 28. Oh, and I came up and I interviewed with JP Morgan because I was frustrated, and I thought I was great in the interview and I didn't get the job. I must not be able to sell. He told me he'd pay me $10,000 a month to talk to me. A couple people that knew me through the bank were going to give me $900,000 to manage, times 1% with no performance fee was $9,000. $129,000, that's more than I was making. I figured worst case I could come to New York and work for a bank if I fell on my face. That's how it started.
Now, after working on your own for a while, at some point you switched strategy, right? You went from being, I guess, a stock picking fund, a long only fund, to what today we would recognize as a macro fund.
Actually, no. Because my background was economics, not business, and it's true, my first venue at Pittsburgh National analytically was stocks, because I was the banking analyst, and because of this guy I told you, the quirky guy, the mentor, he was a top-down, real good investor. I learned about liquidity, and I was very strong in bonds. I didn't tell you in the meeting with the lawyer, I kept telling everybody bonds were going to go down the tubes, which they did. But when I started Duquesne, it was 81. And I had a great first year or two because I put 50% of the capital in 30-year bonds, which was quite radical at the time because they were yielding 14 and Henry Kaufman said they were going to 25, and he was a guru and it was a little terrifying. So you're right, I'd say it was more about when I started running money for Dreyfus, I started to get really more involved in currencies and bonds. By the time I had gone to Soros, he didn't know this. He thought I was an S&P guy, trader, but I thought I knew a lot about bonds and currencies. And it was actually bonds that launched my record at Duquesne, not stocks.
So you went to Soros, and obviously there's a legendary trade happened there that it's basically your trade when you broke the Bank of England, or so they say. Can you tell us a bit about that?
Okay, that was just one of these anomalies in history because Britain and Germany were, I'd say, loosely economically linked, and the Deutschmark and the pound were at a fixed rate. I think it was 178. And the loose economic link was fine until Germany decided to reunite with East Germany. And this created huge demand and basically the strongest economy in the world while that was happening. At the same time, the US banking crisis, savings and loan thing, was in full bloom, and the UK, for whatever reason, even though we're on other sides of the ocean and so forth, they were more correlating with our economy than with the European economy, and particularly at that time the German economy. So they were going into a housing recession while Germany was first taking off from the reunification. So you had one economy tanking, the other economy going like this, one requiring lower rates. The Bundesbank was going crazy, threatening politicians and everything, just raising rates continually. And they had a very strong currency, so the pound was getting dragged up with it. So I watched this for a while, and I was really screwed because I didn't have a chart. It was just a fixed exchange rate, so I couldn't cheat the way I usually do, is look at my momentum curves. But in August of that year, I looked, and the 6-month forwards were 0.5%. Well, I figured it was a little bit of a long shot that I would win, but if I did win, it would be 20%. It was 0.5%. So we were managing $6 billion at the time, so I did $1.5 billion and just decided to sort of watch it. So then 2 weeks before the pound happened, I got a call from a consultant in Washington that the Germans weren't pleased at all with the Italians. And we did some lira, and that worked out. And then, you know, I was just going along, and the forwards were starting to move a little, but it was nothing dramatic at all. And it was as simple as I opened up the newspaper one morning, and this guy Schlesinger, who's head of the Bundesbank at the time, has written an article basically announcing that it's just totally inappropriate for the pound. If you read it, you know how one learns to read central bank. It's just totally inappropriate for these bozos to be linked to the great Deutschmark. So I read it again because I couldn't believe my own eyes. It was in the Financial Times. So I decided to do $5 billion to basically, with the 1.5, take the fund fully invested short the pound. So the arrangement I had with George, which was not the arrangement the first 6 months I had there, where there was no declared leader, it was kind of a mess. But by that time, I was running the fund, and he had his personal account, which, by the way, was larger than most funds at the time. So when I was doing something significant, I used to just make him aware, and a lot of times he'd piggyback in his personal account on what I was doing. So I went into him and I said, I said, George, I just want you to know I'm going to do $5 billion worth of the pound. I don't even think I had told him about the $1.5 billion. I've been monitoring this for a while. I went through the thesis and, you know, the whole economic pitch I gave you, and he goes, that's ridiculous. And I said, excuse me? George, this is like a layup. He says, exactly the point. Why are you only doing $5 billion? So he says, this is a one-way bet. It's not the way, you know, you manage risk. You should do $15 billion. Because the forwards are still like 0.5 to 0.75%.
That whole diversification lesson you learned is out the window now.
Diversification is very overrated. We can talk about it later. But anyway, so, you know, I decided he was right, and that this was kind of a once-in-a-lifetime thing. And it was the same day. It was like 2 or 3 in the afternoon. So I called Citi and a few other banks, and we started, and like went to bed. Had given those of you who know my trader then, he's still my trader, the infamous Steve Oken.
We got a guy back there who does a great imitation, if you want to see it later.
I'd love to see it, and if you call on him, my condolences. But anyway, I get a call about 1 in the morning that this thing is a mess. The forwards have completely blown out. You know, we're not going to get where you want to be. I said, well, how much have we done? And he said, like 5 or 6 billion. And I said, okay, well, where are the forwards? And I said, all right, I'm going back to sleep. You know, I'll get up like 3:30 and I'll talk to you. So got up, and the British had raised their rates. I can't remember where they came from, but they had raised them hugely to like 12%. So at that point, even though the forwards were out, I knew they were finished because their economy couldn't even handle whatever it was at the time. I think it was 8 or 9, 7, something like that. But I said, you know, if they're in a recession at 7, 12 is going to do wonders for them. So, and I knew they didn't have the political will. So even with the forwards blown out, we started to add even more because the forwards, I think, were 5 or 6 or 7% now, and I knew that evaluation had to be 15 or 20. But we only got like 200 or 300 million more on it, and all hell broke loose. And then Norman Lamont came out, and they went to 15, but it was a joke. And then like 4 hours later, it was history.
Now, you've got this big move. You know, you bet on it. You broke them. Did you take profit at that point?
It's very interesting because we made 62% net that year, and we were only up 16% on September the 14th. But I think we only made about 20% in the pound. The answer is no. It didn't go to where it should, and we waited and waited and waited. And then when it got to where I thought it could go, like 16 or 20, we just started slowly bleeding it out. But we actually made more money on the concentric circles than we made in the pound. I don't know whether I've ever disclosed this, but the British gilts were down 2 points that morning. Not 2 ticks, 2 points. Because it's a well-known theory in academia that if your currencies go down, your bonds are going to go down. It's a great theory. Everyone believes it. The only problem is there's absolutely no basis for it if you look at history. In fact, if you looked at history, you'd say the opposite, except you'd be incorrect because you'd be saying, you know, eating ice cream causes hot weather. But generally, when a currency is very weak, your bond market will go with it because it suggests the economy is weak. So the gilts were down 2 points. People are selling like crazy, and we loaded up on gilts. And they went up, I think, 33 points, not ticks, points in the next year. We bought French Matif bonds. We bought British equities. We bought all the things that I thought the blowing up of ERM would affect. And So we took our profits on the pound, I think like 6 to 8 weeks later. And more importantly, the other stuff fed us for about a year. But you ask a great question because, and this is not something I did, but this is a great trading lesson. I wasn't there, but Oken will tell you the story because he was. And this is a great investor. His name is George Soros. And when Plaza happened in '85, he was loaded to the brink with yen, like already too big. And all the little traders there, we didn't have this when I was running Quantum, but they had their little $25 to $50 million capital pools. So they were allowed to piggyback. So they were all long yen because frankly, George was long yen. So the next morning after Plaza, the yen opened up 800 ticks. And George Soros is an interesting guy, but I worked for him for 12 years and I never heard him swear. And I never saw much emotional change. That would last with me for about 4 minutes if you were with me on a desk. But apparently, all these other guys started taking profits. And he had an absolute heart attack. Stop it. Transfer all that stuff to me. They're idiots. And the thing went another 40%, another 4,000 ticks. So the easy thing emotionally was to take a profit, and in fact, George was adding and taking that too because, you can't just make yourself feel good by taking a profit when something goes your way. You have to remember your original game plan, your original thesis, and why you thought it would go from, if it's A to B, wherever B is, and
So, kind of on that theme, but going the other way. So people describe you as very disciplined. At the same time, I've seen you run positions that have gone against you in a long way. I think about, the yen in the 2005 period, or the real last year.
Or the Indonesian rupiah. My worst memory of my life in '96, but let's leave that one out because it won't teach the lesson you're trying to teach here.
Well, actually, I think we'd like to hear about it.
About the rupiah?
Sure.
Oh boy. We had a bigger hit in the Thai baht than we had in the British pound. But by then, certain entities within our firm that were above me had learned to stay quiet when we had a success. But unlike the British pound, the Thai baht was not my idea. There was a guy that worked with us named Rodney Jones. And he had worked for the Bank of New Zealand and he was out in Asia. And Rodney had showed me this chart of Thailand, and loans to GDP had gone from some nominal amount to 150%. He thought the whole thing could blow up. He put it on in February. Big position, no forward costs at the time. And it blew up in July. And so we made a lot of money, and we had a little bit of, well, not a little, but we had a fair amount of Malaysian ringgit. So we're taking profits on the Thai baht and the Malaysian ringgit. And I became convinced by someone at the firm, I've conveniently forgotten who, that the washout was over now and that Indonesia was different. They didn't have the fundamental problems that Thailand and Malaysia had. Turns out they had worse. But I don't quite know what was going on because I think Suharto was funneling money out because the macro numbers were fine. But this thing was unbelievable. I mean, it just kept going and going and going, and I couldn't get out. And to some extent, I was so big relative to the size of the market, I froze. But I lost well over $1 billion in it, and the worst year I ever had, basically flat on the year.
So how do you size your trades? You look at how many positions do you carry at once, and how do you size any one trade?
Well, I think diversification is really overrated, and No, I really do. I'm from the school of if you've really got a great thesis and you've analyzed the risk reward, put all your eggs in a couple baskets or in one basket and then watch the basket very closely. But when I was at Soros, a lot of my positions by the time we got over 10 billion, particularly back then, I always sized them relative to the market, not to the capital of the fund. So I would never get bigger, I would never get so big in something that I thought I couldn't get out where it would cost the fund maybe 1 or 2% in execution cost alone to get out. So that was always a rule, no matter how good the idea. And the pound thing is easy because I could have gotten out at a fixed exchange rate, so that governed that. Now, back when I was younger and not as wealthy, and probably had a lot more courage, you know, it's a lethal triple. I used to take my fund, I'd put 150 to 200% of it in a currency. I'd put 300% in 10-year bond equivalent. Equities, I rarely would get more than 100% net long or rarely more than 50% net short. But our gross leverage very rarely would run more than 4 to 1. But if I really believed something, I'd have no problem putting 100% of the fund in it. Again, with the liquidity constraint I mentioned earlier. And I will say that unlike my competitors, and who knows have the right model, I learned very early on, because I think we were the biggest at the time. At least for me, it's very difficult to run a hedge fund with more than $10 billion effectively. And you know, being from the equity school and having learned currencies and bonds, I felt I had a lot of weapons. So the funds that, to me, are over 15 or 20 billion and still raising money, I don't understand that. And we have tried religiously to keep our assets around the $10 billion level, because my belief is if we let our assets blow up to 40 or 50 billion, and immodestly, we certainly could have any time in the last 3 or 4 years based on the record, I would just have horrible performance and the assets would leave anyway. So our philosophy has been to grow it organically, and then when you get to 10 billion, start squeezing clients out and manage our own money to try and keep it there, because in the long run, A, I've got an ego problem, so I like performing. After a while, it's not about the money you make, it's how you feel about yourself. So that, I guess I've given a very long answer to your question.
So let's get back to, so with Indonesia, it just kept going against you and you couldn't explain why, and lost enough money that you were like, I'm done with this. What about something like Brazil in 08, where you saw it go from 180 to 240?
Okay, so Brazil in 08, I think somebody gave you the wrong information, because I had a problem with Brazil in 08, but it's instructive. I bought Brazil, I think, above 250, you know, and had held it for quite a while. And as those of you know Brazil, I had quite a carry. And Arminio Fraga had been a partner of mine for 6 or 7 years at Soros, so I felt I knew Brazil, probably knew just enough to, you know, be dangerous, but I thought I knew Brazil pretty well, and I'd owned it for a few years. And frankly, at the low, which was just through 160, and it was the first time the Japanese started buying it, by the whole way. They had no interest from 310 to 160, but at 160 they discovered the real. I did take a bunch off, because I just thought this is going to be very tough for Brazil to exist with this exchange rate. And then at 170, 180, the chart turned dramatically. So I think I had been 3 billion, which was really stretching the limits of what I would call liquidity, but I liked it so much, and it kind of grown there organically. So I've already violated the discipline rule I told you about. But I guess I had about $1 billion left when it went through 180. But since I had $3 billion, I convinced myself it was okay because it was only go to like 205. And so it's at 240. You know, it took a couple weeks. And I thought, this is tough. And so I barfed at least 200 or 300 million right at the low. The good news is, some of you must know Anuj Malhotra. He bought it from me internally. I had my own guy buy the low from me inside Duquesne. But it stayed there for a while, and I still liked Brazil. And I ended up adding between 240 and 220 and basically held a lot of it through about 180 or 190 and still have quite a bit. I think what you may be thinking of at the time is I started buying Brazilian rates at 13 or 14. And they violated every chart limit you could possibly think of. They went to 19. And this is really, really rare for me. I don't know when I've ever done it in the past. And I just kept adding because this is the stupidest thing I've ever seen. It's trading with risk, but I think US 2 years were 40 basis points. Or, you know, we kept lowering our rates. And that was one of those rare cases where I ignored the charts I told you that I never ignored because I just thought it was just so fundamentally ridiculous. And we held them all the way from 18 or 19. These were the January of 02s down to, down to 10. We held that trade for years.
So is it really, you know, when you've got something
that's like a 1 in 100 for me to violate to that extent.
When you're violating the charts. It's the charts that'll signal to you to get out.
Yeah, I have never used a stop loss in my career. I don't use a number. I know that's a discipline system and I know it works, but I have like conditions. If it starts not acting well relative to news or other things I'm watching, you know, I'll get out. So I probably do have a stop loss in my head, but it's like another golden rule I have is January 1 has always been a great resetting of risk for myself. And for those of you who gamble, you probably know that 95% of the people that go to Vegas lose money, but the odds are 33 to 32. So 95% of the people shouldn't lose money. It's because people who get down want to go home and tell their spouse that they made money, so they start betting big when they're on losing streaks. And then when they get up, they want to tell their spouse they made money, so they're playing very small when they're doing well, and they're playing bigger and bigger when they're doing poorly. So we have always believed January 1 is sort of when the house starts, and if I'm up, and I think this is the reason so far we haven't had a down year, I'm sure we will have one at some point, but when I'm up, I'll play much more aggressively. And I see a lot of managers who get up 20%, oh, I want to book my year, I made my high water mark, let's go to the beach. I'm the opposite. And frankly, I learned a lot of that from George. If you're up 20 or 30%, you're playing the house money, that's when you try and get up 60 or 70%. And you're usually hot at the time. Any of you who have managed money, the most important thing is to monitor yourself. I don't know why streaks happen, but they happen. They happen in baseball, they happen in putting, they happen in money management. And one of my jobs is to know whether I'm hot or cold. But I will say, just like the Brazil thing, if I'm down 8 or 9% on the year, I'm playing very differently than I'm up 15 or 20. But if there's a great opportunity, I'm not going to go, oh, I'm down on the year, I'm going to put my head in the sand. I'll play it. It's just more of it's an intuitive general feel.
Another time you turned it around was 98, where you looked like you were going to miss the tech bubble, and you were short going into the fall, right?
I think you're thinking of 99, but this is a horrible period, and I try to black this one out. You're bringing back all these nightmares. But 99 was the first time in my career, and I started in 81, that I felt my fund was really in trouble and I was in trouble psychologically. And it really started in March of 99. I had shorted $200 million worth of what I would call low-quality internet stocks. Now, mind you, this was not early on. AOL was up eightfold, Yahoo was up. These things had already gone way to the sky. So I shorted $200 million worth of internet stocks. I would have done more, but I had my liquidity rule. And I lost about $800 million in 13 days. They gapped open, like a $100 stock would open at 130. You try and buy a little, it'd be 170. So I took my $800 million loss. I just said, get me out. You know, discipline thing you're talking about. Indonesia taught me something. So I had some currency trade not working, and in May, we were down 18%. And I'd never had a down year, and I'd had big drawdowns, but always from like up 40 to up 20 or something. So the summer wore on, and you know, I was watching this thing, and my charts on the technology stocks looked incredible. And it finally dawned on me that Greenspan was responding to the Asian crisis, but it wasn't appropriate for the United States. So we were running a world monetary policy, but rates were required much higher for here. And the charts were just screaming at me to buy tech.
I think someone said, the quote you said at the time was, the Fed was throwing a party and I was missing it.
Well, if that's what I said, that's what I said. It sounds familiar. So, so I loaded up on tech stocks. And I think we ended up 42 net on the year, and we were still down 8 in early November. So we made about $5 billion in November and December, all in tech stocks. Now, I might as well keep going because the next part's a real nightmare. And this is a lesson in money management. So in January, we still own these tech stocks, and we're now up 13%. But a lot of my technical indicators were horrendous. I mean, I think there were 13 new highs and 242 new lows on a year-over-year basis, but the market was going up. It was all like 10 or 15 tech stocks. So I sold everything and was flat and up 13%. I went into George and told him why I did it. He said, that's great, you know. Well, I had these 2 internal managers that I had hired to buy the go-go tech stocks, the ones I didn't know how to pronounce, VeriSign, Veritas. I only knew old stuff like IBM and Hewlett-Packard, who had helped me gun the fund in 99. My God, they were making 6 or 7% a day while I was sitting out, and I just couldn't stand it. And completely lost my cool and my discipline. And after being out for a few weeks, and they'd made another 30% or something, I jumped back into the tech market. And to be fair, my momentum charts were bullish, but they were bullish for an equity chart, but I had seen commodity charts do this and just fall out of the sky, because again, my stuff is rate of change and second derivative. Anyway, I bought these tech stocks all back, and about a month and a half later, I was down 18% again. It was like the nightmare of the year before. And the worst thing is I knew when they were down, when I was down 1%, I knew I was toast. And I just started liquidating, told George that I couldn't take it anymore. I was leaving, and told him I was going to sell everything, and we could have a press conference in about 3 weeks, but I wanted to get out of my stuff first. And went on sabbatical. sent a letter out to my Duquesne investors and said, my head's all screwed up. I'm going to take a break. You can leave the fund, and that's fine. By the way, if you leave it, you won't necessarily get back in if you want to come back in, but no charge if you stay in. We lost one account. And by Labor Day, that was May, by Labor Day, because I had nothing else to do because my kids were going back to school, I came back. And I've had a lot of luck in my life, but this was maybe one of the luckiest things ever because I came back in late August, right around Labor Day, and oil was screaming upward, interest rates were screaming upward. You'd had this huge rally back in the S&P and the tech stocks that I had sold, and everything I had ever looked at told me we were going to go into a recession. And plus the NASDAQ had been down 30 or 35%. And I had the analysts that I rehired call some companies. They all said business stunk, and everybody on Wall Street was, 18% earnings. And Ed Hyman had this simple little model, 50% dollar, 50% G7 rates, and I can't remember what the other, 25% G7, I can't remember. Anyway, it spit out earnings are going to be down 36% in the next 12 months, and Wall Street strategists had them up 18%, okay? So I'm not a rocket scientist, but up 18, down 36, and this thing had fit like a glove for a while, and it fit with everything I believe. So Fed funds were 6.5, 2 years were 6.04. We were down at New Cane, we weren't down 18, we were down 9, but I'd throw in, I finally have a down year, that's it, it's over. Man, this looked like red meat in front of anybody who hadn't had a steak in about 10 years. And I was fresh, the 4 months off had really helped. So I literally put 300% 10-year equivalent of the fund in 2-year notes. And we made a lot of money. In the next few months, and it ended up, I don't remember, 15 or 20 nets, something like that. But that was like a miracle.
So what is it you think that makes a good trader? I mean, I know you got a lot of friends who are pretty legendary traders, all with different styles. You've had a lot of people work for you, people that you've worked for. What is the common denominator?
Well, I'd say, first of all, they're extremely competitive. They have an unbelievable will to win, and that just, if you look at anybody with a great investment record, for whatever reason, the people without passion can't compete with them because they have passion and they're willing to just work harder, and you're in the wrong arena if you think you can compete with those maniacs if you don't have that passion. Number two, they may have very, very different styles, but they're all disciplined. And I just told you about 4 times I wasn't disciplined, but that's over about 30 years. And it doesn't even matter what your system is, but as long as you follow it, there are a lot of ways to make money. And with regards to that, you really, really have to fight your emotions. Because I have wanted to sell every bottom so bad, and a lot of times I'm buying there, I'm always doing, it never feels great when you're at a turn. The other thing I have found is that contrarian investing is way overrated. People tend to, it's intellectually cool to not be with the crowd, but the crowd makes money 80% of the time, and they kill themselves at the turns and end up losing as much as the turns as they make during the 80% of the time. But I have found contrarian thinking just to be contrarian can be a death trap, particularly in bonds and currencies, because economic fundamentals are what they are. It can be a rough ride if it's very crowded, but I think the main thing, Jeff, is you have to be disciplined, you have to be unemotional, and to me, the really great ones, you have to really be able to play, you have to have courage, you have to play big when when the opportunity's there. Make hay while the sun shines, whatever the term is.
One more question before we take some Q&A. You know, we've brought all our foreign exchange and local market traders from the Americas and a few from Asia and Europe here today to talk about, over the next 2 days, how to grow your risk.
How to grow?
How to grow your risk, how to take more, how to get bigger. You know, you seem to have no problem driving it, although you had the help from a mentor to push yourself to get bigger, to take more risk. Are there any other, besides having someone push you, what helps you be confident enough to step it up to the level?
I think you just have to follow, you know, whatever your style or whatever your system is, you just have to follow a disciplined pattern, and you have to teach yourself that you're good. I mean, I can remember in '87 and '88. In '87, I caught the crash, and I was on a couple magazine covers, so I was really smart, okay, but I was convinced we were going into a depression. And '88, the stock market kept going. I can remember getting up 2 nights a week, throwing up and thinking, oh my God, I went to Bowdoin, I never got a degree. I can't be a plumber, what am I gonna do? This might be random. You know, I might have just gotten lucky for 6 years because we were a bull market playing a trend. And, you know, I had made 42% a year compounded, and I was thinking that way. So it's not easy, but I think if you follow a disciplined system, you just have to watch your own results, and you have to believe in yourself, and success breeds success. And again, one of the things with me is I know when I'm hot and I know when I'm cold, and you have to learn to play big when you're on a streak. A lot of times when I'm cold, I'll just start trading really small, and the whole purpose of the trading is to find out when I've got it again. And every once in a while, you'll think you'll got it, and you hit 8 in a row, and then you bet big, and ooh, I missed. And that's tough. That's probably the toughest thing you could ever do. That's the old whipsaw term. But you know, you just have to dust yourself off. But I would say the way to get big is follow discipline, watch yourself, and then just grow organically. What I would never do, ever, is if you swing and you miss, is put on a big trade just to get even. I got to get out of the trap. That is that's a death sentence. Don't bet big unless A, you love your thesis, and B, you're hot. Now, if you really, really love your thesis and you've had a lot of successes in the past, that's what I'm talking about. For example, when I put that treasury bet on when I came back in 2000, that's fine. But don't ever bet big just because you think this is the way to get out of a mistake you've made.
So when you're losing, I think this is key, get small, keep trading. Was 2000 the only time where you said, that's it, I really gotta get my head out of this, I'm gonna square everything up and go away?
Yeah, Jeff, I was exhausted. It had more to do with all sorts of psychological factors, which you have to know when you're a trader, but I had been running the most public hedge fund for 12 years with a guy who had a need for publicity because his philanthropy and his status were enhanced. I don't think he was doing it at the time because of his ego. It enhanced his position in philanthropy. Well, I'm a private person, as you know, if you try and find anything out on Duquesne, and I was just tired and exhausted. And in '99, I think money management's a little bit like a boxer and body blows. You get these body blows. And '99 took a lot out of me, and do it at 2000, and my kids were 9 or 10. So yeah, that's the only time I did it, but let me tell you, there have been 10 times when I wanted to do it. And at those times, I just trade small, suck it up, and try and remember all the successes I've had in the past, and this will end at some point. I'm really not that stupid, which at the time you feel like you are.
All right, why don't we take a few questions? Anyone want to kick off? Pete?
I've got a question. I guess I feel a point of disagreement. My view is that, and I know it's very common to press when you're doing well, when you're on a hot streak to do more. I'd have to say, kind of anecdotally, that when I've seen people have a really good string of success, not early, but after a mature string of success, is when they're at their worst. They get sloppy, they get overconfident. So I would kind of disagree. And I just want to ask you specifically, why do you think that when someone's doing well, that it's a time to take more risks?
Well, I believe in streaks, and I don't know whether you do disagree, because what you're talking about is someone who loses their discipline. And you cannot allow, you make a good point, you cannot allow yourself, when you're doing well, to start thinking you're God and lose your discipline. But I do believe that life and trading runs in streaks, and if you're still disciplined with what you're doing, when you're up 20% with clients' money, you have the right, if you really like an idea, to bet more than when you're down 10%. And I'm not saying, oh, I'm up 20%, let's go shoot for the moon. What I am saying, everything else equal, if you're playing with house money, and if you're doing well and you're trading well, you should definitely take bigger positions than otherwise. But no, I'm not saying I'm up 20%, let's just get, and I've hit 8 in a row, let's get reckless. So I'm not sure we do disagree. I may not have articulated my position well. But if you look at the best part of my record at Soros, I literally didn't make a mistake for 5 years. Literally not one. And then for 2 years, I stunk, okay? And if I had gone in any of those 5 years from basically 89 to 95, well, I've done too well, I need to take a break. You know, I probably would have lost half my net worth that I have now. So, different strokes for different folks.
Tom?
Yeah, when we used to work for you, we sort of had a saying that the risk management system was you. And I think it might be interesting
Yeah.
if you talk a little bit about how you thought about the allocation process of the money in the fund, and how you thought about it before and after LTC. Because I'll never forget LTC.
Right. This is
I walked in on the morning where you were.
I don't remember when you walked in, but this is a terrific question, because I have never had a, well, I did, but I didn't pay attention to it, and it's what Tom's alluding to. I have never had a fancy quantitative risk management control system overseeing me. And by the way, either did George Soros in the 25 years he ran the fund before I did. And between us, there's one down year since 1969.
So there's no VAR at Duquesne.
Well, there was, because the banks came in and made us put it in after 98, okay? But I believe that every once in a while, usually about every 10 years, you have a financial crisis. And all these systems that are based on historic trends and what happens when A does this and B does this, spit out a formula. And they work 95% of the time. But when you really, really need risk management, they break down, because by definition of a financial crisis, which I'm sure everybody here knows because we had a recent one, correlations just go wacko. The stuff that has correlated for years breaks down, and you start seeing changes that make no sense whatsoever. And my risk management system is, and I believe this is true with George, although we never talked about it, you know, if I own, let's say in today's world, the last 10 years at least, if you own stocks and you're short bonds, that most of those 10 years has been the same bet. And if you're long the euro, that's probably a long risk bet. And you just kind of get a feel in your head of where your matrix is. And I can go in the gym and watch CNBC at 11 o'clock, And I have probably, if you include the whole firm, hundreds of positions on, and all I see on that stupid little ticker is what the S&P is doing. And I can probably tell you our P&L within $2 million, just because my head knows what my pound or my euro position will be doing and my gold position based on that. And so I sort of have this internal thing where I'm watching everything, but the reason I love the human side as opposed to the quantitative side is there's nothing like my P&L, and you will pick up, oh, C is not acting the way it was with A the last 8 years, and there's something funny, and then you'll start seeing more funniness going on. And I have always thought that if my P&L if things went well that day and I'm losing money, and I examine what went on, and if that continues, something is really starting to go haywire in the system. So my risk management system has always been what I've described, that knowledge, and then my gut and watching my daily P&L. And if the daily P&L starts acting in a way it shouldn't, instead of going to some quantitative VAR or beta model, oh, I'm okay, the model says I'm okay. To me, these models are not only okay, they can get you in huge trouble by causing you a false sense of security when things start going awry, because the model will tell you you're okay, and you will see things happen you've never seen before. Whereas if you are a intuitive human trader, you should be able to use your instinct to just start cutting when things aren't acting right.
Do you ever, if you're thinking about the correlations, if you're long a lot of S&Ps, will you say, well, I'm bullish the euro, bearish the dollar, but I'm not going to take that big a position in that because they're correlated?
Yeah, and that gets back to this question. If I've got a strong opinion and I'm doing well and we're up 20%, and this is what happened in the early 90s, and I've got 8 positions and they're all in the same direction, it's an 8 times Texas hedge, I have no issue with it. But if I'm down 6 or 7%, I might just take my favorite of those positions and press that alone. But yeah, I am constantly weighing that, and you know, one of the reasons I plowed into those Brazilian bonds is they had traded with risk since I'd owned them. It was crazy. A couple times they moved 200 basis points because you had something going on here. I mean, it had nothing to do with the Brazilian economy. And about a month before the big signal they turned was the S&P kept crashing into the financial crisis, and they stopped correlating. And that they were 18 or 19, and that's when I knew they were golden, because I had watched them trade with risk for 2 years, and my antenna, the intuitive part I'm talking about, I said, oh, they're not trading with risk, and this is a really cool thing because I'm long them. And that's when I bought more of them.
All right, one more, Scott?
I am the worst hirer in the world. And, you know, my mother-in-law says I'm an idiot savant. She's probably right. You know, so far I've been able to compound money above a random level. But I just took that to someone else in my firm. So if I was hiring a money manager, the first thing I'd look for is if all I heard was they never made a mistake and they're telling me about all their wins, that's a big red flag. The great money managers I've met, they generally don't tell you about a lot of their wins. They tell you about a lot of their losses. And there's an immodesty about them. But yeah, I would definitely look for discipline. The first thing I do when I look at the records, I go right to the bear market periods and see how they did in those, and look at the quality of the record. Because Hiring money managers, I'm okay, actually. It's analysts that I have a problem with. But yeah, I would look at all the things I'm talking about, but I think you can learn a ton from the record just by looking how they did in certain years. And when you see an outlier, you ask them, because there'll always be one or two inconsistencies in there. Like, I was flat in '96, pretty easy year. Why? Turns out it was the Indonesian rupiah. But you know, and I think you need to delve in what the reasons were in those unusual period, or are they just a bull market creature where they rode a trend?
What are your thoughts on the markets today going forward? Any big views? How are we going to make money next year?
Well, I've had, I believe, maybe the worst year I've had relative to the opportunity. We're up about 10%, somewhere in that area. And I think the opportunities have been tremendous this year, by hindsight, of course. I made the decision, we had a very good '07 and a good '08, when the government got involved to the extent that they did, and look at all the factors, that my skill set was not as valuable as it had been in the past, because I was dealing with a set of variables that I didn't want to bet big. And Jeff, I still think this is one of the most unanalyzable periods I've ever dealt with, because I tend to look at history and historical, I try to find similar instances. And I was on a roll until September of '08, because it looked like the '30s, but worse to me, because we came in with more leverage, and then we started running a monetary and a fiscal policy exact opposite of what we did in the '30s as well. Now, so that's my big qualifier or hedge, since I run a hedge fund. And I'll start out by saying this is more uncertainty than I would usually have, and no one knows. And if you meet anybody who really thinks they know what's going to happen next year, stay away from them, because they're an idiot, okay? But having said that, here's how I see where we are. First of all, usually in a big-time financial crisis, and we've seen this in a lot of emerging markets, usually something really productive comes out of it, and you usually get very positive structural reform. Now, I am no fan of George Bush, for those of 43, for those of you who have known me for quite a while, but I do think it was kind of bad luck, at least for structural reform, that this thing blew up on the smaller government side of the equation's watch. And I blame that guy for a lot of things, but I don't blame him for the financial crisis. To me, the seeds of this started 20 years ago when Greenspan took over for Volcker, and then he decided he didn't want any recessions. So we've just been, you know, we've gone from 140% of GDP to 380% on debt. And, you know, it went parabolic, and he ignored it. So the problem I see is we had this big mess, and instead of getting healthy response to it, which would be demanded in an EM country, and an EM country would come out of it usually much better, and a lot of times rise from the ashes, which is why I think if you look, probably the countries that weathered this the best were obviously Latin America and Asia. Asia went through the Asian financial crisis, and the Latin American countries were on their deathbed in the early '80s. And they made the right response to it eventually, and the seeds of that and the benefits of that went for a long time. And I think the last really horrendous thing I saw in my career was this whole '70s thing, and the end of it, and Carter was sort of the epitome of it. And out of Carter, we got Volcker, and we got Reagan, and we basically got a 20-year bull market out of some guys that were really to take some serious pain for 2 or 3 years. So my problem with where we are today is we went into this thing, we have this thing, and not only have we not gotten structural reform, we've done everything wrong. And it's all kicked the can down the road. And we got into this thing through, to me, a reckless monetary policy and not willing to take the pain and not willing to take a recession. And ironically, I call it the curse of the reserve currency, which is, you know, this thing, the curse of oil, that the country with oil under the ground.
Dutch disease.
Yeah. The problem with it being a reserve currency is we're allowed to get away with non-reform and behavior, and you keep doing it and doing it and doing it. And normally the markets would give you a signal and they would save you from yourself before it was too late. I am deeply afraid that all this stuff we're doing, it's the wrong answer. I mean, capping bankers' pay, this is our response and all this other stuff. Why don't we just get, knocked down? Instead of dealing with the real issue, which is leverage, too loose a monetary policy, it's all this populist nonsense out there. So I am convinced that this crisis we've just had is going to be followed by a bigger crisis because we didn't do what we needed to do in response to this crisis. And now is where it gets unanswerable and unanalyzable, which is our response to it, which is how we got into it, which is more liquidity, let's not have any pain, 10% unemployment, buying 20 to 25 billion in either treasuries or mortgages a week, makes everybody feel good, causes another asset bubble, but it's going to cause hell down the road. And in this one, I think the Fed and the Treasury were big enough to arrest it. At the next one, I think there's a good chance that they'll be the problem. I think we're going to have a sovereign crisis due to everything we're doing now. And normally, it would be arrested because the bond market would give you a signal. But with China trying to hold their own currency down, so they're buying treasuries, Korea, everybody knows who's intervening every night. Brazil will be intervening, and we're intervening. I mean, we're buying 20 to 25 billion. Isn't it nice that we don't want to target asset prices at the Fed on the way up, but for some reason we're buying them? Isn't that targeting them? But anyway, so this liquidity that they're putting in there, you can't go, oh, the economy stinks, so I hate the stock market. It doesn't work. This thing, if you have the money supply growing a lot faster than industrial production, the stock market is generally going to go up. That's just the way it works. That's where the money goes. But at some point, we're going to get a signal. When that signal is, I don't know. It could be in 3 months or it could be in 3 years. So basically, I'm pretty useless other than telling you, I would not be shocked at all if we take out the 680 and the S&P again on the downside, but that could be in 3 or 4 years. If you put a gun to my head, I'd say, given where liquidity is now, if January earnings are strong, and I suspect they will be, and the markets are hot enough, these guys will end QE at the end of March is what they're saying. If we get weak again, I'm not sure I believe them. But if they end QE, I would be willing to entertain the fact, since all my long-term theses tend to happen before I think they're going to happen, that it'd be very unlikely that risk would be up year to year in 2010, that sometime in the first quarter before the end of March, we'll start backtracking. When the big crisis comes, I don't know. Personally, we're playing a low gross because I can't figure it out. We are tilted toward long risk. We're in the liquidity thing. My favorite currency is gold. Again, very popular, not a contrarian bet, but my thesis there is quite simple, that just like we had an anomaly in '92 with Germany and Britain, we have an anomaly now, and the anomaly is, if you look at the world balance sheet, it's okay in total, but it's obviously ridiculously imbalanced. So our structurally impaired balance sheet is somebody else's decent balance sheet. So debt to GDP in China is 120 or 130. Here it's 370, and you could go on. But that's, so basically, because we're the reserve currency, and because no one else wants their currency to go up, we are running more monetary policy, and since we have a structurally impaired balance sheet, for the world as a whole, that monetary policy is way too loose. It's appropriate for us, possibly. I don't think it is, but you could certainly argue it is. It's definitely not appropriate for the world. And everybody hates their own currency, and that's why I like gold. And then we're also long a bunch of commodity currencies, basically for the same reason, but I would put gold at the bottom, gold at the top if I was from Mars of my currency regime, followed by selective commodity currencies, and I would put the pound and the dollar at the bottom, obviously, because they have structural problems. Bonds are incredibly interesting because they are the stupidest price. They are ridiculous. But again, my discipline requires, I'm not just a value guy. I need charts, I need catalyst, and I think they're a one-way bet except carry, but the carry's big. But I am salivating to short the bond market in major size. That could happen tomorrow morning. It could happen in 4 months. It could happen a year. I don't quite know, but do I have a second?
Yeah.
Okay, so in '81, what launched my career was we had 18% short-term rates. We had about 14 or 15 inflation, and the long bond was yielding 14. And we had a crazy guy running the Fed named Paul Volcker who was going to do anything to smash inflation. And all the bond guys were bearish. And it cost they got 400 basis points of carry by being short bonds, okay? And interestingly, the only bond bulls were equity guys. Michael Steinhardt, Roy Neuberger, George Soros, myself, although nobody ever heard of me. And we could see that this guy Volcker was going to win, okay? Now, it's a very interesting situation. It costs you 400 basis points not to own the bonds, but to be short the bonds. We got, in my opinion, a crazy guy running the Fed, okay? He's hell-bent on inflating. The bond guys are all bullish because they're getting 400 carry. They can't believe what a party they're having. The equity guys are all going, this is a disaster. When I go and I meet CEOs, every one of them thinks we're going to have inflation. I don't know whether they're right or not, but So to me, it's almost the mirror of 30 years ago. When was George Soros' one down year? 1981, he lost 22%. Why? He was long bonds. He was just 6 months early. I don't want to be 6 months early and trash myself, but I'm salivating. But it's, I don't know the timing of it.
And last question. In your personal life, the one thing that is well known is you're a big Steelers fan. You're on the boards of a bunch of charities, but I know that your real focus is with the Harlem Children's Zone. Why did you pick that one?
Well, I hit the lottery with this guy, Canada, but basically, it's a pretty simple story. When I went to work for George, he had just retired from money management, and he wanted to give away $500 million a year. I had no money, so I never thought about philanthropy. But when I started making money, I had a personal mentor, and it seemed like the right thing to do. But living in New York, first of all, I'm kind of parochial because I came from Pittsburgh, so I wasn't really into the arts, and I thought giving to the Philharmonic and the MoMA was, I don't know, they seemed to have plenty of money and plenty of supporters. And I had a good friend I had just met named Paul Jones, and we had a lot of discussions about poverty in the area. So I joined the Robin Hood board, and we had a board meeting up at the site at this place called Reland Center for Children and Families. And I went up this sort of like dilapidated stairs up into this little room, and I meet this guy, Jeff Canada, and within like an hour and a half, the hair was standing back on the back of my head. I said, this is like one of the greatest, most dynamic leaders I've ever met. What's he doing in this little room? And then 5 or 6 years later, I was on the Reedland board. It was Jeff, not me, that thought up the concept of the Harlem Children's Zone, presented it to a board. I mean, this is like discovering, you know, Bill Gates in a garage, as far as I'm concerned. And so, you know, he's had a massive impact with 100 square blocks up there. And now, as you guys probably know, Obama's trying to use our model to do it in 20 cities. And it's outside of my family. It's been the joy of my life. But I just got lucky, and I don't know why I was destined to meet this guy, but I did.
Well, I just want to take 1 minute, and I want to introduce Arnold Prasad, who's my boss. He runs FXLM.
I think you guys should know me by now, at least this time of the year. Though we are a top bank, guys. Thank you very much, Stan,
Thank you.
for your comments. Thank you for coming. And Jeff, thank you for
Appreciate
hosting it. We have a surprise for you, Stan.
Oh, God.
Since you're a man that likes to follow these markets and likes tumultuous times, is Jeff Canada somewhere here?
Oh, there he is. How about you? I didn't mean any of that stuff I said about him.
Hey, how are you? Good to see you.
So Stan, we thought we'd want to do something for you coming here and spending the time with us. And then we realized that we are a government-owned bank with limited resources, and no one wants to pay us. But anyway, we asked the senior managers of the bank to put a donation together for the Harlem Children's Zone, and they did, and we raised $140,000.
Well, thank you.
Which
Thank you
we
so
are
much.
very proud to present you and Jeff.
You want it?
So that is from most of the senior managers in the markets area.
Well, I know what the government's doing to you, so I know 140,000 is not what it used to be. It's a lot more. So thank you very much.
Thanks a lot, Stan.
Deeply appreciated.
And I would just ask, just so we can talk about what happens next, anyone who's in the FX element part of our meeting, if you could stay for a couple minutes and we'll just tell you where we're going. Everyone else, thanks for taking the time to come.
Thank you.
Thanks, Jeff.